Mr. Wennink, to start off, what are the highlights for the quarter when looking at your operational performance?
The quarter was a good quarter. The final sales for ASML on a standalone basis came in at 1,155 million, which is 55 million over the guided range. Our gross margin was at the high end of the range. We said between 41 and 42%, came in at 41.8. We were on target with our costs, so it was a good quarter. Orders came in above 1 billion euros, so excluding the Cymer acquisition, I'm very pleased.
Talking about Cymer, the ASML margins are impacted by the Cymer takeover. Can you help us understand, are these one-off items or are these recurring items?
In the second quarter, it was a one-off. It was about 18 million, which had to do with the purchase price allocation and the resulting purchase price accounting adjustments that need to happen. The operational result for Cymer for that 1 month in the second quarter that it was included in our consolidated result was about 0. But with those purchase price accounting adjustments was 18 million of extra cost. The gross margin was impacted in the second quarter about 1.2%, and the net margin with about 2% as a result of this.
And what do you expect for the coming quarters?
Going forward, we see for the second half of this year a non-recurring item which is related to the revaluation of the inventory, which will be sold in the second half of 2013. That impact will be about 60 million euros, and again, this is non-cash and it is an accounting adjustment. On top of that, we have 20 million of amortization of intangibles. That will continue in the years to come. And we have 20 million relating to personnel expenses. Has to do with the remeasurement, the revaluation of the ASML shares that Cymer employees got as a part of the acquisition. So all in all, in the second half, about 100 million of non-cash accounting related adjustments.
You raise your expectations for the full year up to 5 billion euro in sales. What drives this increase?
The increase is largely driven by the fact that our memory customers, especially our DRAM customers, are coming back. We said the last quarter that logic remains very strong for 2013, also for 2014. We see very strong demand for what we call the 20 nanometer logic node. So that is the same as we said 1 quarter ago. Only our DRAM customers, the memory customers, are coming back because there is clear shortage in the DRAM market, especially with respect to mobile DRAM.
Yeah. And do you expect these trends in logic and DRAM to continue into 2014?
In 2014, logic will definitely continue because we're just at the beginning of the 20 nanometer ramp. With respect to DRAM, you need to remember that the last 2 years, the DRAM industry was really in the doldrums. There was a lot of capacity taken out. And the demand for mobile DRAM is picking up quite significantly. So the DRAM industry is now experiencing undercapacity, which need to be refueled. And we're just seeing the start of it. So yes, I do expect also in 2014 we see a continuation of the demand.
And what does it mean for the company, the visibility for 2014?
Well, 2014 is far away. So we think we've guided for 2013. We give you some indications of where the market can go in terms of logic, in terms of memory. And it all bodes well, but it's too early to be specific on 2014.
EUV is approaching commercial implementation. You are discussing the start of EUV at the 10 nanometer node. How many of these machines do you expect to sell?
You have to look at the EUV ramp in fact 2 phases. The first phase will be for the 10 nanometer logic node. That is going to be an inevitable node. Customers have to do it for the simple reason that we're finding out today that in order to go for the maximum shrink, which means cost reduction, our logic customers at 10 nanometer need to move to EUV. They simply cannot get to smaller chips when they use the multiple patterning strategy. That will happen in any case. So you could say the first phase is for what I would call the shrink only. And that means that our current capacity, which is for 2014 12 to 15 units, and 2015 25 to 30 units, will be sufficient to deal with that phase, the first phase. The second phase will be the phase where we bring EUV to 125 wafers per hour, which is the economical phase. and that phase will be 2016. So we're convinced, no matter what the throughput of EUV will be, whether it's 70 wafers per hour, or 80 wafers, or 90 wafers, the customers will go for the first phase to do the necessary shrinks, and we'll follow in the second phase where we get to 125, but that will be 2016.
What at present is the progress you're making with the source?
The source progress is gradual, but is good. We've shown very good results at 55 watts stable. We are now working to get to 80 watts by the end of the year, in the September-October timeframe, and we will have 70 wafers per hour by the middle of 2014. And that is our target, and we're well on track.
As part of the customer co-investment program, you're working on the development of a 450 millimeter scanner. Can you update us?
Yes, we have received this year funding, starting January 1, 2013, to be able to deliver in 2010, by the end of next year, the first EUV 450 millimeter scanner, in 2015, the first immersion 450 millimeter scanners. That is the result of the co-investment program for which we received the funds. We will do those 6 prototypes, what we call the so-called debug tools. If we need to ramp up, then we will ramp up. If the industry believes that by 2018 they need a volume ramp, we will be ready. So in that sense, we are preparing for the prototypes, and if the industry needs more, we'll be there.